FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next. Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz, and well, today is 9/29/20. Well, you're like me, you're always looking for new ways, new investments, perhaps outside of the mainstream that won't be as susceptible to economic disruptions like COVID, like market declines, etc. And we've got a new twist for you. It's not really new, but somebody who's been doing it a while, talking about note investing. And I'd like to hear from you if you've done any note investing before or thought about it. Why don't you send me an email to kl@kerrylutz.com. Right now, we've got Martin Saenz on with us. Martin, you're a managing partner of Bequest Funds, and you're a renowned thought leader in the mortgage note investment industry. And we really appreciate you coming on. Hey, mortgage note investing, can you just briefly tell us what's involved here, what it's about?
Sure. Thank you, Kerry, for having me on your program. Just kind of first off, I just love the name Financial Survival Network. I mean, survival is what it is, right? I mean, it's a constant grind to make sure that you're going to come out on top when this is all said and done. As for mortgage note investing, what it is where you buy and sell mortgage notes in the secondary market space. So you can either transact with notes that are performing or notes that are non-performing. So what that means is if you are a buyer of non-performing mortgage notes, you are purchasing mortgages whereby the borrower has not made a payment in, say, 4 or 5 years, and you are working with that homeowner to get them back on their feet with payments they can afford while still making a profit for yourself. Now, if you're purchasing performing mortgage notes, which there are those notes that are available in the secondary market space, then you're buying them at a yield return, and they're already going to be performing and cash flowing for you. So those are really the 2 types of mortgage note investing angles that take place.
I guess, and it sounds very, very potentially profitable and probably it's secured investing effectively because you're buying a mortgage, whether it's performing or not, that's secured by a piece of real estate. I guess the first question that you're going to have out there is, how do you find such opportunities? They must be out there, but I know there's websites, et cetera, that list such mortgages, properties for sale. But how do you find them, and how hard is it to find them?
So, I'm going to answer, it's relative to the note investor, right? So it depends to answer your question, which isn't really answering your question. The key is that if you are someone that is just new to the industry and just getting started, then there is a whole host of online exchanges out there, PaperStack, LoanExchange.com, various online engines that is like a marketplace whereby you can buy and sell mortgage notes. And now that being said, that's more of a retail play. So it's equivalent to the MLS on the real estate side. And you're not going to be able to build a long-term sustainable business model buying in a retail setting, right? Like that's regardless of the industry you're in. Now, for those that are committed to operating a note business then for those individuals, then you become positioned in the note space, and it is a very small club, if you will. It's a very tight-knit community whereby people know each other. Reputation is everything. Ability to close is everything. Having access to capital and knowing what you're doing, how to vet these notes is everything, because it's a very convoluted industry. So when you're buying at larger levels, then you need to have a business operation that can support that. And over the course of time, you'll be positioned to engage in larger takedowns and really grow your business. So really, those are two types of ways to come into the note business. However, everyone pretty much comes in through the retail channel initially.
All right. So what are some of the pitfalls of these notes? I mean, what do you find people who've had negative experiences? What is it that you've done wrong that you should have done right?
So it's good that we're focused on what is note investing, how it can help someone. Because if we wanted to just dedicate the segment on the pitfalls, then we would probably need about 10 hours, a 10-to-1 ratio to cover it, because there's many, right? Nothing comes without a catch, and the industry is very complex. For one, if you garbage in, garbage out. So if you're not vetting the note correctly, then there's a number of ways to buy. There's a number of ways to lose money. Everything from not understanding the fair market value, which is property valuation, to understanding lien validity and lien positioning of the note that you're purchasing, understanding the borrower and their ability to pay based on skip tracing that you're performing, credit reporting analysis, as well as ownership of the property, back taxes. There's satisfactions, things that can kind of rear their head during a title search. And so you really have to play in a number of different areas. In other words, in the legal arena, in the title company arena, in the real estate investor arena, as well as kind of mortgage arena, because you have to understand collateral files, and you have to be able to ensure that all the I's are dotted and T's are crossed. If a borrower's didn't sign the promissory note, well, then that could be an issue, or didn't initial a page, that could be an issue, or if it was written incorrectly and there's an error, issue with errors and omissions, that could be problematic for an individual. So those are just kind of a few of the pitfalls, and that's actually just in the vetting phase. So throw in overpaying for notes, and your margins aren't going to be realized like you projected, and also various techniques in the asset management side of things, whereby you're working with homeowners to convert the note from a non-profitable state into a profitable state. So there's various techniques and strategies that way that can determine whether you make money or lose money.
All right. So it's not for the unwary or the uneducated, because obviously you need to know a lot about real estate, like you said, liens, credit reporting, all types of things like that. And when you've seen people kind of mess up, what have they done wrong?
Well, I think the number one thing I see out there is that we have a lot of individuals that come from the real estate investing side, where they're just used to looking at how are the windows, how is the roof, how's the exterior, is there mold, and these kinds of questions. And so they come into the mortgage note world because they're tired of swinging a hammer, or they're tired of transacting as a realtor, and just having every month be a new month, like Groundhog Day, and they have to just reinvent sales and stuff and things like that. So you have individuals that come in that way, and what they don't realize is that there's a promissory note component to the industry. So in other words, when you go and take out a mortgage, you sign a promissory note, which is a promise to pay back the lender given a certain set of terms, and that mortgage or security instrument is tying that promise to the property. So both the securitizing of the collateral, the mortgage, deed of trust, and the promissory note are of equal importance. So it's not enough just to look at what the property's worth. You have to deep dive into the borrower and their ability to pay, because in the end, if they're not going to pay, then you're not creating cash flow for yourself. The property doesn't pay you every month; the borrower does. And I think a lot of people kind of go through a lesson learned in that regard.
Yeah, so there's definitely risks involved here. And so I go and I buy the note. How much will I usually pay for like a performing mortgage versus a non-performing mortgage note?
So the going rate is about 14% yield that you're going to get when you purchase a performing note. And now understand that when you're buying a performing note in the secondary space, it's not as if Bank of America or PNC are just going to sell their performing notes in the secondary space. That's never going to happen. They're in business to create and retain those mortgages. What's going to happen is at some point the borrower has defaulted. Some hedge fund or note investor has picked up that note. They have got it to start performing again, and it's become seasoned. So after it becomes seasoned, then it's considered a performing mortgage again, and then it's sold in the secondary market so that company can recapitalize. So when they resell it, they're selling it at about a 14% yield currently. Now, price does fluctuate based on supply and demand, of course.
All right. So you're not buying it from BOA or from JP Morgan. Who originally makes mortgages, extends these mortgages to these borrowers? Is it a private seller?
So initially, on the performing side, we're not purchasing directly from those financial institutions. So in other words, those financial institutions are not going to ever sell off performing paper. So we actually do buy very closely with major lending institutions. We have paper, directly from PNC, Deutsche Bank, various other lenders that you would recognize the names with. So, but when we buy that paper directly from those lenders, we buy it in a non-performing state. So we do have reach to those major lenders, but for non-performing paper, because they do pull that paper together and sell it off in the secondary market.
Right. And when you're looking at mortgages, some states are more advantageous, their laws, than others. Are there certain states that you stay away from?
FSN Radio. It's all about what's next.
With multi-million ounce potential at its Yellowknife District project, Gold Terra is a company on the move. You'll find them at goldterracorp.com, and their ticker on the OTC is TRXXF. On the TSX, it's YGT. The management team is headed up by near legend Gerald Hanaton of Detour Gold fame, who's convinced that Yellowknife's potential is far greater than its current 735,000 ounce resource. The mine benefits from great infrastructure. Employees can pick up breakfast at Tim Hortons on the way to work. And there's multiple high-grade discoveries, putting Gold Terra on track to reestablishing Yellowknife as one of the premier gold mining districts in Canada. And that should do wonders for the stock price as well. So head on over to goldterracorp.com and sign up for their notifications now.
The Financial Survival Network. It's all about what's next.
Yes, so we buy in all the states. However, with that said, we have a very sophisticated operation where we understand rules and regulations within the various states, and we lean on our legal partners to ensure we maintain in compliance with everything we do. That's a very costly and labor-intensive way to operate. And this is where a lot of individuals that are on the newer side, they have trouble getting established because there's an increasing regulatory burden placed on lenders within the various states, and you have to know all the nuances, or that can create a big risk for you as an operator. So we do have licenses where we need to have licenses. However, it's an ever-changing target as new licenses are created. Existing ones are modified. So it really takes a lot of effort to stay on top of the compliance angle.
I'm sure it does, but certain states are recourse, others are non-recourse. Certain states have deeds of trust where a trustee sale, non-judicial, and others like Florida and New York could take you years to foreclose upon the property. So where do you draw the line, I guess?
Well, it's more of a question of how do you price. So it's really, it comes down to your pricing strategy. So if something's going to take you longer to move through legal and come to resolution with the borrower, then you have to account for that in pricing. But we buy in all the states, and it's just a matter of price for us. We have a full-blown asset management operation in place with a team of individuals. So to us, we're working and modifying loans that we bought a month ago, and we're modifying loans we bought 2 years ago. To us, it really doesn't matter. It all just gets plugged into the cycle.
I see. Interesting. And what kind of returns can you get here on non-performers?
So, non-performers, you can get anywhere from 20% on up, northbound. And that's, depending on how the volume that you purchase the pool in. Obviously, the more that you purchase at a single time, the better pricing you'll get and the better returns you'll get if you vetted that pool properly. However, on the low end, 20-30%.
Interesting. So when you're doing this, though, you got to have resources for lawyers and legal fees, right?
Yeah, I'd like to also mention, because this is an important point to make, is that it's one thing when you look at the potential returns here, we're talking 20-30%, and that's on the low end. However, what needs to be understood is that there's a real social good with this, in that since we bought it at a discount, we're able to make those returns and still work out payment plans that fit borrowers' budgets to help them get back on track. So oftentimes we're actually lowering borrower payments. We are forgiving arrears. We're doing other forms of forgiveness to help people get back on their feet, versus, say, a traditional lender that if you fell behind with a traditional lender, let's say 3 years, and you call to make a monthly payment, they're going to reject that monthly payment, probably send it back to you if you mailed it in, because they want full reinstatement to do anything for you. But when we hold on to that paper, you call us and we're going to treat you like a human. We're going to treat you with compassion, and that's how we operate our business, so that we can really work out a plan that will help someone stay in their home. And if they stay in their home, they create a 30-year cash stream for ourselves. So that's the business side of it.
Yeah. So your goal is to take what's otherwise a non-performer and turn it into a performer. And you can do that because you've got flexibility that the lender doesn't have, because you can, like you said, forgive arrears, cut the interest rate, and tailor the payments in a way that you can afford, or the homeowner can afford to actually make payments, and you don't have to bring it current. In other words, you don't have to pay all those back taxes and penalty interest, all these things.
Yeah. So if someone calls us up and they owe $50,000 for principal balance and they're past due about $20,000, meaning every day they have not made a payment, there's a per diem interest charge that gets assessed to their account. So which is termed past due interest arrears. So let's say that accumulates to $20,000, that plus monthly late fees. We can work with the borrower and maybe they say, hey, look, we can put down a few $1,000s. Well, put down a few $1,000s. We may do some forgiveness and get them back on track with a payment they can afford, and whereby we do very well for ourselves on our side. Now, we go one step further and we've created a legacy play called Bequest. And what that means is our operation runs as a cradle to grave operation. So what that means is when we initially work with the homeowner and build a relationship with them and get them back on their feet with a payment plan they can afford, from that point, those asset managers stay with the borrowers for the life of the loan. So in other words, we retain all our paper, and we've created an income fund called Bequest Funds, which is where we place seasoned performing notes that meet other metrics into the income fund, and we bring in investors to share in the profit of those mortgage notes. And Bequest Funds is an SEC registered fund, so we work with accredited investors in that fund.
I see. And so obviously you need a collection apparatus in place to see to it that these borrowers stay current.
So what we do is actually it's an ongoing monitoring process. So what we do from a controller standpoint is we will monitor our reperforming pool of mortgages, the mortgages that are paying us every month that rest in the income fund. And if a borrower has some trouble, or a borrower comes in and calls in and they have some difficulty in a certain way, then they'll speak to the original asset manager that worked with them, because there's already a relationship in place, and we'll figure out a solution to help them get back on track or overcome whatever challenge they have going on. But at the end of the day, if they stop performing, because there are going to be some loans that just stop performing, then we will work with them within Bequest Funds. But if we have issues, we'll just swap them out for other performing notes, because we want to maintain the integrity of the income fund, meaning that investors are buying into an equity position into a fund that holds a pool of performing notes. So we don't really want individuals to feel like they're getting involved with a non-performing play.
Okay, and it sounds interesting. Obviously, what's happened recently with COVID-19, the resulting economic calamity or collapse that's occurred, what effect has that had upon your fund?
Well, we haven't seen the collapse yet. It's coming. Businesses and real estate are overvalued majorly. So it's about to come, I think, soon. But anyway, what we look at is we look at collectability percentages with our portfolio, and what is acceptable in our industry is a 90% collectability percentage. So what that means is if you have 10 loans that are performing, you're anticipating 9 out of the 10 to keep performing, because recall, these were purchased at a discount. So it's not as if they were purchased at par, and your risk is mitigated just based on the fact that you purchased them at an initial discount. So 90% collectability percentage is what we look at, COVID or no COVID. And we've been running at 93% collected all year in spite of COVID. And we do have a COVID process in place for anyone that has been affected. And, we work with those borrowers accordingly. But 93% of our performing pool is continuing to pay.
All right. And totally understand that, and sounds good. I guess the proof of the pudding is going to come in the tasting when this thing really hits. as you said, it hasn't yet. A lot of it, I guess we're going to find out how good this is.
I think we'll find out soon. I think we're going to find out in winter, unfortunately.
Once the forbearance period is over?
Once the forbearance period's over, once, COVID reenacts or escalates in the country, once the election comes about and 50% of the population's pissed, once, businesses that have been running on fumes are going to go bust and file Chapter 11, and the real estate bubble will burst because disposable income's not there to support it. I don't know. Maybe I'm negative. What do I know?
It's interesting. Yeah, well, certainly it's something you need to consider because this really is unprecedented. So people are interested in finding out more about this, connecting with you on the web, etc. How do you do it?
Yes. If you visit bequestfunds.com, so BQFUNDS.com. You can get more information, and we're growing our fund. It has the fund has no leverage, so essentially, as investors put money into the fund, we go out and source and purchase notes that are viable notes to grow the fund. So we're making an organic play. I am the largest investor in the fund, so I lead by example, and I'm just having fun, to be honest with you, Kerry.
All right. Well, it sounds like a real interesting take on, I guess, what's an old business, and going to be interesting to see how it sustains when things get really bad. If they do, hopefully they won't, but certainly all of the concerns that you voiced are very, very accurate and of great concern to everyone in the country. So we've got a link to bqfunds.com in the show notes. Take a look at it, see if it's right for you. Any questions or comments, you can email me, kl@kerrylutz.com. Our Twitter feed's at Kerry Lutz, Facebook page, Financial Survival Network. Of course, our main site, financialsurvivalnetwork.com. And sign up for our free newsletter. Got a new one coming out in the next couple of days. Really appreciate your coming on and sharing this with us. And Martin, we wish you the best of luck.
Thank you, sir. Appreciate it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next. FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.